Kirill, good morning. Good to see you again.
Good to see you, Carlos. How you doing, man?
I'm doing great. So I'm gonna start with a question that's come up recently in among one of my clients. Their challenge was optimizing their application flow to minimize the friction down. And what that was going to enable for them in their affiliate marketing platform was just get channels like Experian and Credit Karma and Lending Tree and all the others to send them more deal flow. So I immediately thought of you because I know Truv focuses on income verification. So I guess opening question is, how would you advise a lender to vet a potential income verification partner?
It's a good question. So if you start with what question you're trying to answer, you're trying to really understand, not just verify income. You really want to understand, can you underwrite this consumer? And can you get additional information outside of just the credit score, right? And identity information. So you want to make sure like how likely you run into a situation where the person would not pay you the loan back, right? So if that's the problem you're trying to solve, then going back from that problem, there's the first obviously line of defense is just, can I verify your income, right? Second line of defense is, can I look at your transactions and can I understand your bank data? If I don't have bank data, then can I actually then ask you to upload some documents to make sure that there's no fraud? So I usually talk about how complete the solution is. And I think one of the benefits of at least working with us is we have a fully baked solution. So we can look at payroll, verify just income, and that gives you a very rich data set around like what type of income you have. Is it stable? Is it mostly bonuses over time? You won't get that data from looking at the bank account. Second is, can you connect bank? We have a product that is now competitive to Plaid with certified in assets and mortgage, and a lot of consumer lenders are using us today. So the idea there is we can aggregate the bank data. And I think from the perspective of the market, the N10 of 3, bank aggregation is commoditized. But all in all, if you look on average, if you have an average consumer, average American, everybody is the same. The difference is negligible. So then the difference really comes down to, you look at my bank account and figure out how the income looks like, but also really well give me like risk signals from the expenses, right? So if I could look at your bank account, let's say you work with like I have an account with Chase. I log in, and actually Truv, what we build is we build a very good machine learning model to rebuild the pay stub just looking at the bank statements. So that's how you get income. But then if you look down, you can actually understand very well what the expense profile looks like. So you might be making a lot of money, but you might be spending all of it. And how you spend also makes a big difference. And that gives you like the risk signals. And the last bit, if your borrower doesn't want to do any of that, then they can upload pay stubs and W-2s. If you run risk scores on your existing documents, most likely you'll find a bunch of fraud. So end to end, the problem is not really understanding just income. The problem is how do you understand the consumer end to end and the borrower end to end. And being able to work with various data sets. Sometimes income not fully baked income, but also expenses, and sometimes just the documents. And that's where Truv really, we abstract away all of these problems, right? So when you look at a vendor, what you want to find is a vendor who can look at the data, abstract away all this complexity for you, so your team can actually get clean risk signals and then build back from this risk signals, whether you want to underwrite it or not.
So I want to hit on a few of the things and unpack some of the stuff you share, but let's start with the consumer friction here. And you mentioned solutions like Plaid, where I'm assuming the user has to provide their like bank username and password, something like that, right? What are the complete rates you generally see? Like how much, like when someone's presented that in a lending application flow, what percentage of people pass that step? Like what do you typically see as the conversion rate there?
I think we see about 35% drop off.
So my concern as a lender seeing a 35% drop off there would be that the 35% who drop off might actually be my best credit. Like those are the folks that maybe have other options, and at the slightest sign of friction, they leave. And the folks who stay might actually be a little bit riskier than the average. So that's what I would worry about as a lender. So let's talk like instant databases. Is that a scenario where like calling an instant database before an authentication step makes sense? Like I guess what you've written publicly around like the concept of a waterfall. Like walk us through how the lenders kind of do this in practice.
So in practice, what you want to do is you want to have perceived friction from the borrower is like has to be low. So when they open something like Plaid or they open Truv, they actually have options, right? You can log in, we call it Choice Connect. You can log in into your payroll, you can log in into your bank, you can upload documents. Don't want to do it, say I don't want to do it. Then if you don't want to do it, then you hit the instant database right away. So what you want to do is you want to subsidize the instant database cost with a very cheap solution up front. Affordable solution, right? And consumer permission data is arguably usually like 1/3 of the cost, if not less, than of the instant database. So you want to run affordable solution first, then you want to run instant database, and then what you have left might be self-employed, it might be actually miscategorized users, or it might be simply fraud. Because if you cannot find them in any of the database, they don't want to participate in consumer permission data, you want to look at that pile closely. And we call it at Truv is like, how do I reduce the pile?
Got it.
Because the challenge with fraud and the challenge with buybacks is you don't want to sift for every single item in the haystack. You want to find that needle. And as the haystack gets smaller, it's easier to find the needle.
I like that a lot. Of what you're describing sounds smart because it's a little bit best of both worlds, right? So you're presenting either the Truv interface or Plaid or something like it. But then it sounds like there's an option that's a link underneath that says I'd like to verify some other way. Something like that. Is that how it's actually implemented? Or okay.
Yeah, you can say skip verification. You it's also the copy that you put in, right? It's like, hey, you can maximize your chances for approval if you do this. If you don't want to do it, you can skip verification. We can take care of it later.
Yeah.
And that's how you build a waterfall, right? It's like some folks, they might skip it, and that's okay because you might still want to approve them because of high FICO. But if they skip, if you didn't approve them, you can bring them back and say, well, we give you an option. Can you actually do it? And they can still opt out, and then you can run the instant database. So you want to put the instant database when you exhausted all of your options, and that's when you do it. And that reduces substantially the cost without creating drop-off in the funnel.
And when you go the instant database route, what's communicated to the customer in that circumstance? Is it like, hey, I'm gonna check with like what do you like? Does you need the consent from the user or not? You don't even need the consent.
Usually collect the consent up front with same as the soft pull, right? Or hard pull. Whenever you're collecting that credit, running the credit risk, right? Like the credit report, when you're collecting the consent from consumer to do that, you're also collecting consent to verify income.
So back to the theme. Okay, so that helps me understand how you think about like the consumer side of this. Back to the theme of vetting a potential partner. You mentioned a lot of the providers boil down to kind of the same sources. So like what are some questions a lender could ask to kind of get at the guts of the underlying solution?
So first, as a lender, you should run an RFP, right? You should seriously look at every provider. And the way I would run an RFP in a data-driven way, even if you don't make it a fully baked RFP where like answer 25 questions or 2,500 questions. We've seen all kind of RFPs. You at least want to do the backtesting analysis. And the backtesting analysis is the most data-driven way for you to identify which of this group of vendors would be the best fit for you. Once the backtest analysis is done, then you can make a very data-driven decision. You should be able to verify the same kind of backtesting analysis with their own API. And we build it that way where it's like trust by verify. When we give you the results, you can actually go back and see what the user would see. You can see the metrics for that connection. So that gives you as a lender, instead of doing all this like sales back and forth and how does this feature look, how does that, you're buying data.
And do you see these RFPs generally conclude with one vendor selected that takes all the business, or are lenders horse racing different options to see which one works better in production?
I think it still mostly lands in with one vendor.
Okay.
And the reason why it's quite a bit of work to implement multiple, right? But you want to select the vendor that you're comfortable working with, that has very good documentation, so you won't spend a lot of time on implementation, and somebody who've done the backtesting, so you know what you're buying.
And is the same true when they move over from the incumbent to the new provider? Are they moving all the traffic at once, or are they scaling their way in to make sure things are working?
I mean, once you've done the backtesting analysis and business case, you'll see that it's so straightforward to make a business decision to move. Because usually within 30 days, what we saw is you run a test for 30 days, you look at the metrics, right? Even if you run it on a small portion of your traffic, it becomes very clear that your drop-off doesn't increase too much, right? And the people who dropped off, if you look at that pile, actually, it's not the people who you wanted to underwrite in the first place, but your cost for instant goes down substantially. So as a result, the 30 days out, the business case works. And then the question is like, do you want to ramp it, and we handle now millions of transactions every month. So from that perspective, it's really easy to ramp Truv. It's not going to break. We don't see a lot of bugs. And when somebody is ramping us, right, you're just basically scaling the business case that you see in the first 30 days.
Let's take a quick break in the action here, because I'd like to introduce you to our newest sponsor, Fintel Connect. They're an affiliate marketing platform that can help connect you to publishers, influencers, and manage your compliance. You may have heard of platforms like CJ, Rakuten, and Impact, but none of those platforms serve financial services companies exclusively. That's where Fintel Connect shines. Folks that have used their platform tend to talk about their compliance platform and their ability to connect with social media and influencer publishers that you may not find elsewhere. Additionally, because they're FI only, they have a deep empathy for the challenges that lenders and banks have when they run their affiliate marketing programs. I'd love for you to check them out. You can find them at fintelconnect.com, FINTEL connect.com, where you can connect directly with their founder and CRO.
You've talked about this concept of a complete product in the income verification space. And I assume you mean the concept of a waterfall, where there's different sources hitting on, for different customer types. Is that what you mean by complete product, or is there more to it?
Yeah, complete product is exactly that. If you send me 100% of your traffic, doesn't matter, either the employed, unemployed, W-2, asset-based, lending, whatever you have, how many of those can I theoretically verify? And now the answer is probably 90%, because we're still working through self-employment, but we have a partnership coming up. Once that's done, then it's going to be 100%. And then it really just relies on how excited is the consumer about doing this with a partnership with you as a lender. So if it's 100% theoretically, then can we chip away at 80% rate, 90% rate, 60, 70% rate? That really depends on implementation. And now we've done it over 300 times. We have a good idea of how a good implementation looks.
Got it.
And that is also something that I see sometimes lenders just add step after step, and then you see a lot of drop off. What you want to do is you want to just ask for all the information up front and then go directly into underwriting so you can make a decision instantly.
What are some of the different, I'm assuming you mean there's connectivity to different payroll providers, maybe an ADP, something like that. Then there may be government institutions, for folks that work on the federal side. You may have, I'm guessing, a solution for gig workers. What are the various classes of income that you're looking at? How stratified does this get?
There's a lot of complexity. So W-2, right? The W-2, if you look at somebody's bank transaction data and you're looking at somebody who looks like sales, it's really hard to underwrite that person. Because one month you have higher commission, next month you don't have higher commission. It's just highly variable. So you would underwrite on something that's considered to be a baseline, and probably it makes it a little challenging. So payroll might be better for that, right? Some companies, you can't log into their payroll. They either don't have it or it's blocked for outside access. So you want to go the bank route, right? Sometimes you want to go the bank route, but then you realize that, look, this person doesn't have one account. They have multiple accounts, and they split their payments and like the salary into multiple accounts. So all of this complexity is like just around W-2. Then you come to gig. Gig is 1099. You don't need to gross it up, but how do you get the data? You can go directly into Uber app, or you can get it from their new fintech account. Then there are folks who are doing like having benefits, for example, somebody who gets benefits from security administration, somebody who's getting benefits from Veteran Affairs, and so forth. You might get a letter, you might look at the bank account. Do you gross it up? Do you not gross it up? So this is where complexity really starts. And then there's obviously self-employed. So there you don't know anything other than, well, this person submitted taxes in April, and who knows how their situation looks today.
Got it.
So going back to your question about you want just somebody who abstracts all this complexity away. You want to just get one data report back and say like, okay, what do we have here? And then you work with that vendor and the partner to construct your risk decisioning based off of the data that comes back. Because the data for a gig worker looks very different than W-2, and somebody who is self-employed looks extremely different from somebody who is doing Uber today.
Does a Truv customer have transparency into all those little decisions you're making behind the scenes?
Of course. Yeah, we'll be very transparent, and you can see everything on the report.
And is there a degree of customization? Like if a lender didn't agree with how you grossed up or how you smoothed income, could they change some of their parameters if they wanted to, or like how would that work?
That's the idea. That's the idea of building a complete product.
Got it.
I keep telling my team about you know this idea of like why airlines beat the railroads. It's a long story. Like I went to business school a long time ago. And the idea was railroads were always in the railroads business, right? It's how do you get from point A to point B, and the railroads were competing with the railroads. And then when airlines came, they actually were in the business of transportation. So now if you're trying to take go from I'm in Miami to DC, I'm not even considering railroad anymore. So what you want to do is you want to build the business that, like, I want to build a solution that solves the problem. And the problem is, how do I make a most informed decision about underwriting this borrower? It has nothing to do with like how my bank aggregation works or what's my coverage in my instant database. Who cares? Well, it matters, but if you want to scrabble solutions together, yeah, that's a good idea. But if you want to just somebody who abstracts all of this decisioning away from you, and you understand how decisions are made every step of the way, but you're not concerned about, as a lender, you're not concerned about how the sausage is made in the sausage factory, then you want to find a partner who actually thinks about this problem holistically end to end, has a complete solution, and tries to build a complete solution.
So let's add another layer to this. I think it relates to having a complete product. You've written about Truv not being an income verification provider, but rather being in the business of preventing buybacks for mortgage lenders. Can you expand a little on what that means?
It's the same story about just risk decisioning, right? Buyback usually happens when you didn't understand the risk of the borrower up front, didn't follow the guidelines. And in mortgage space, that can be pretty devastating for your business if you get buybacks. But same as in consumer, right? If you're underwriting relatively sizable loans and you miss on a bunch of them, you miss the fraud signals, or somebody told you that I'm making $10,000 a month and they're actually spending $9,000 out of it, and you have very little money left to service your loan, that's when the buybacks happen. Right? In mortgage, buyback, this literally means somebody, Fannie and Freddie, they acquired the loan from the lender, and then they made the lender buy it back 6 months later. So that's the challenge. In consumer lending, it's roughly the same. It's just there's nothing to buy back. You literally are not getting, you're not seeing your money back from the borrower you give the money to. Yeah, so what's the problem we're solving? We're solving the problem of understanding how risky is this consumer versus, well, can I verify your income? Yeah, I can verify your income. That's great. But can I help you actually understand the consumer end to end? And that's been always the vision.
So is the idea for Truv to have some sort of skin in the game in the buyback scenario? Like, is that something that you contemplate?
Well, in mortgage, it's sort of different because once you verify income, we're an approved vendor with Fannie and Freddie. So it's different, right? So I don't think we'll ever participate in buybacks. Where we do participate is we don't get paid now until you get paid. So we rolled out this model, which is per closed loan. Buybacks is a little tough because we don't control the full loan, right? Otherwise, we'd be a lender probably. If you get a response back saying that you get reps and warrants for income, because there was enough data, the data was high quality, and Fannie and Freddie considered that data set complete, then you wouldn't get a buyback based on income, but you might still get it on some other factors.
I want to pause here for a second to tell you about one of our sponsors, Spinwheel. They've built an API that streamlines your lending application form with just 2 fields. When a customer shares just their birth date and phone number, they can go grab all the information needed to pre-fill their application form. So regardless of what channel you play in, you know that the higher the application rate goes, the lower your cost of acquisition becomes, and the more media you can buy to generate growth. Additionally, they can give you real-time verified consumer credit data and seamless payment processing, which can help you serve customers beyond the initial application. To see a demo, go to spinwheel.io or check out the link in the show notes. It'll hook you up straight with their head of growth.
All right, so walk me through this new pricing model. I think you're describing the pivot from charging per data, which is, by the way, very normal for like per ping. I think that's the norm. The Work Number, all the other guys anyone I've ever spoken with, charges per transaction. Like there's a data record sent to me and I pay per record. You're pivoting to a model where the lender will only pay you after they've used your data and generated a successful conversion on there, so like monetized it somehow. So how does this all work? Like how did you come to that decision? And B, how does it actually work in practice? Because I assume you're going to have to price every lender differently based on their conversion rate.
Yeah, all of that. So let's start with how this problem came up, right? Over the last 3 years, specifically in home lending and partially consumer lending, I was asked like many times, like, what happens if the loan doesn't fund? Like, well, you have to pick up that expense. How much is that expense? Can we estimate it? And then you have to build a business case anyway to understand like how much money is it going to cost the lender, right? If your conversion rate is 10%, it's going to cost you quite a bit of money, more than if your conversion is 50% in your funnel, right? So what we came to conclusion is, if we have to do all of that work anyway, what will make the lender really comfortable using us upfront and not worry about any expenses? And the really only solution is when you get paid, we get paid. And that means we have to be paid only when the loan closes. It doesn't apply to everything. Sometimes it's just not worth building that type of business model. Sometimes some lenders don't want to do it. They prefer to use only one product instead of using the full waterfall that we offer. But in the world where we believe that you want to remove as much expense up front, we're the only one who provide that type of service. We have the full complete product. At the same time, we're willing to not charge you for, just per drink, right? We're only charging you when your business is making money. And that requires a much tighter integration, much tighter partnership. But also, as a lender, you get the benefit of not thinking about like how much is it gonna cost, because we price you once, you get that price, and you don't need to worry about it. Because historically, you've been somebody clicked the Work Number button 25 times somewhere in your a loan origination system, and you picked up so many expenses. So what do you do with it? Right? And we kind of eliminate all of those headaches for our lenders. And the lenders love that because from their perspective, we're very aligned to them. They can tell their teams that it will never cost more than X. And that certainty gives a lot of freedom to the teams in the field to use it. When it comes to more online digital lenders, the challenge there is obviously the conversion. Conversion can be way lower.
Yeah.
So you don't want to sometimes run verifications, because if you get charged per verification, then okay, you might pick up too many expenses up front. But also, as your funnel gets bigger, as you get more and more like smaller check lending, you actually can predict it well. So as your checks, like as your loan size gets smaller, you don't need the per close loan funding model.
This is a question I've been asking a lot of our guests recently. It's very, very topical. I'm assuming you've spent a lot of time thinking about it too. The impact of AI, not only on your business, but on kind of the partnerships you have with lenders. Do you see AI having an incremental impact on this category, or just a transformational impact, and and why?
Internally, we believe AI is just an automation tool, right? If you start with that perspective, if you could hire 1,000 workers and you could write a very precise instruction to them and ask them to execute it and work as teams, that's what you can get with AI. That's why there are so many companies now generating like $10 million with like 2-3 people. Because in reality, it's not 2-3 people. It could have been like 150 people company,
right,
24 months ago. And that's how we think about it. We think AI for this like lending category is going to remove all the manual work. So if you're underwriting and there's somebody in the process today who's looking at anything manually, that will be gone. So for example, we used to have quality checks on all of our data, right? There would be a person in support spot checking at least like a few hundred transactions a day.
Mm-hmm.
All of that is gone today. Like there's no QC, manual QA, that's all gone. It's been gone for, I would say, 9 months now.
On your business, on your side of the business?
Yeah,
or on
on our side of the business. Want to make sure that we deliver high quality data.
Okay.
Same with somebody who was fixing bugs. A lot of bugs gets fixed by AI now, and especially on the long tail of providers that engineer would not get to fix in the next few days. If there's only a couple of transactions a month, it's like a small credit union, then let AI do it. So I think what happens is AI makes you more productive. All the manual work where you used to have team members to do that manual work, that would be gone. Mm-hmm. So everybody's becoming more productive. I think for the category, it means that it's going to be just much more profitable to underwrite, but also everybody will look roughly the same. Would be less human touch.
Yeah.
And would be less leverage from operations sophistication, because you could just buy a solution and the solution would produce the loan for you 100% with very high quality. So it will just speed up things, but also from that perspective, you really want to get the data from the source. So from our perspective, getting something like Truv in place is a no-brainer, because if you expect that AI can generate perfect like driver's license, if AI can generate perfect pay stub, then how do you actually check that the person is real? And even bank you can trick, right? You can create fake account. Payroll is really hard to trick because you have to go through multiple cycles of somebody's paying taxes on your behalf. No fraudster would do that.
Right. Because you've mentioned in the past to me, you have a good deal of clients in the mortgage category. And what I find interesting about that category is almost all the deals flow through a human. Like there's a mortgage loan officer that talks to people. What do you see to the future? What's the future of the mortgage loan officer? Is that going the way of the AI, or is there a human role that's going to persist beyond this transformation?
If you're accelerating your career, maybe you'll buy 2-3 houses in your lifetime. And that's how most of us look. So wouldn't it be nice to have somebody who does those transactions every day to even like give you just walkthrough of what are the options? Yeah, I could do it with Claude or ChatGPT, but honestly, I would rather also talk to a human. And I think that's how the future looks. On the back end, it will look like credit card underwriting, where everything is instant, everything is right away, everything is done to the kind of with the best quality, very little fraud, very little risk. But on the front end, you would actually, I think a lot of mortgage lenders would become more like much more sales focused, less operations focused. So those people who are in the field actually selling those mortgages would have to become much more solution driven, advisor driven, less focused on operation. The operation would go away.
Got it. But it sounds like the role that the human provides in giving the consumer the confidence to make that trust step, you don't see that getting delegated off to AI anytime soon.
I doubt it. I think
at
not.
least in the mortgage category.
If you're making one transaction or couple transactions in your lifetime, no. If I'm like trying to get like a consumer loan, it's already there. Nobody's looking at my at my application manually.
Yeah, we've been there for a decade or longer on the consumer side.
Exactly.
Mortgage is a little different because it's a big ticket transaction, and there's just more to it than a credit card or a personal loan. There's more verification steps. There's the asset that backs the loan. There's a bunch there. So the number of questions somebody will have is much greater.
I think where you would want to have a real person involved is either very big check, like mortgage or home equity loan, or somewhere where it's like very high risk, like deep subprime. And we have customers on both sides. If you want to win that business, how do you actually make the options less rough for the borrower? And for you to do that, you have to understand the data directly from the source, but you also want to talk to the person, right? And that's why if you look at the largest lenders in the country, they're actually more like brick and mortar type of deals, and less just like if you're doing deep subprime, it's much more brick and mortar.
Interesting. Cool. Well, Kirill, this has been awesome. I appreciate the walkthrough on how to vet the income verification players out there, how you all think about things at Truv. If anyone listening to the show wants to contact you, what's the best way to find you?
Truv.com. Just or you can email me at Kirill@Truv. I'd be happy to chat.